Hi guys, my name is Victor Godele, and today we just want to take a look at MTN on Nigeria. Currently they released their FY23 of financials, and I just want to do a personal walkthrough. Right, just let me say, I would just want to do a few review of what the business valuation of the company is and the share price. Please note that this is only for learning purposes and as such, and please don't make a decision based on this. We have our new guys that are just coming into the industry, and yeah, most of them are struggling to really understand how to get things done. So that's one of the reasons I'm also doing this to just it's just for learning purposes. Let me just keep it like that. So please don't make a decision based on this. And this is my own personal view. This is my own personal approach. I can be 100% wrong. I can be also right. So uh, please just know that it's for learning purposes. All right. So this is the annual income statement as per audit as they've presented it. I've taken my time to extract from FY18 to FY23, and this is how they usually present their own financial statements. Now, to we the valuation analyst, there's this particular structure that we prefer, and it's not just for anything. We are not tampering with the values. We are not going to alter any value, but we just want to see certain profitability line item that will give us insights and also in doing the valuation to be able to also compare them to what is obtainable in the market. So what I've done is I've taken my time to do a few categorization. So we have our revenue, then we have direct costs, operating costs, then we have our EBITDA line item. Now, in categorizing this into direct costs, operating costs, yes, we might not be 100% accurate as compared to how the management would have done their own restructuring. Also, I try to look at the way other platform they've also tried to do the categorization. How the management also did their own categorization, and to be candid, it was difficult to get the exact value the management uh, had. So what I had to do, as I said, remember the whole thing is not to distort their financial or change their figures. It's just those profitability line items. So you know what? I'm just doing a valuation. Let me focus on the key line that I need. So I had to redo the restructuring again, and what I did was just put the revenue, the cost, just added everything together and added the comment both direct and operating cost. I really don't need the gross profits. EBITDA is my main line item that I need that will allow me to compare their performance uh, with other comparables. So here we have the EBITDA, depreciation, then we have our operating profits and every other thing below. As I said, we are not changing the values, we are not changing their figures. Everything still remain. The profitability remain the same thing that they have in their financial statement. So that is for the income statement. I also took a further step and extracted their balance sheets. Now, this is balance sheet as per audits, just the way they have it in their annual financial statements. Then I went ahead to also do few restructuring, and one of the restructuring that we usually consider in balance sheet is if you take a look at the balance sheet as per audit, we have trade and other receivables. Right, anytime we see anything like order, it's always a concern, and we just want to know what does this entail. So trade and other receivables, and then we also have current, we have trade and other payables. So anything that has those other things, we just want to be sure, considering this has significant impact when we are measuring their net working capital. All right, so which means we need to we need to pay attention to that. So now what we've done is we've restructured it. So under the trade payables, just I kept it simple, right? My the whole thing is we are not auditing what's been done, but we just need a clean line item, right? That we can also use as a driver when we are doing the forecast. So trade, then we have other receivables separated. Then for the payables, I have trade payables, the clean one. Then we have other payables. So below it, I also did the breakdown, what I've extracted, and how I've decided to recategorize it for that balance sheet. Now, I took a step further and I also had to do the restructuring of the balance sheets in another form. So, and this is what I actually need. As I said, this is my own kind of approach. I might be wrong, I might be right, and it's just only for learning purposes, please. So here, non-current assets, property, plant, and equipment, right of use assets, intangible assets. Keep it simple. Now, also to note that the reason why we usually have that our financial statement as per audit, the way it's been structured is based on a standard, right, accounting reporting standard. But for we valuation, we are not doing our structure for standard sake, right? We are doing it to be able to make informed decision to get those key line key metrics that we need in making our decision. So, non-current assets, those three, the net working capital, inventory, receivables, prepayment, then we have our trade payables. That's our net working capital. Then every other thing comes under the net debt. Now, this net debt, yes, there are different approaches to it. Some people prefer just take this line item, just take this line item. But as I said, my own approach, after non-current assets, I have my net working capital. I believe every other thing should form part of my net debt, right? And then I can, because that can give me my net assets. So it's easy for me to see you. Yes, this is their claim, a net debt. So please, in case you don't know much about net debt, you might want to take a course on it for you to have a full understanding of when we are saying net debt. What do we have in there? So yes, we have the net assets. Then we have our equity, which is also the funding. And as I said, we are not changing the auditor's figures. You can see this will also match with what we have in the audited financial statement. So I've taken a step further and I just reviewed those ratios. So I only want to do the markets. I only want to do the income approach, right? And also market approach using the EBITDA multiple. So those key line items that I need in computing my free cash flow, those are what I've focused on. I've not forecasted their what their performance will be. That's not my focus. As I said, I just want to review their valuation and also to keep in mind that this is as at December 31st. So everything I'm doing, I'm assuming I'm taking a stand as if today is 31st of December. So here taking a look at what their year-on-year growth has been, and right, look at the average, look at the median. However, I think I feel comfortable considering they've been able to maintain this almost the same growth in the last 3 years. That's really commendable to be candid for a mature entity. Their total costs, right, including the direct and indirect costs, they've also maintained a good margin over the last 3 years. So I think I'll prefer to focus on the last 3 years. Yes, even though we have 5 years, I prefer those 3 years because the 3 years seems to have more like a consistent trend. However, I'll also look at the OPEX year-on-year growth. Something really happened in 2023, and we understand the Nigerian market, not even Nigerian market, I think globally, right? So here you can see the EBITDA margin for the past 5 years, right? This slightly lower margin in 2023, and that is understandable considering the OPEX increasing significantly, right, from 21, just increased by 34.4%. That's huge, right? Depreciation and amortization, they've kept that good range. Operating margin as well decreased. You expect that considering EBITDA margin has also decreased and the increase in the OPEX. Then profits before tax, they had a loss, and that was due to the net foreign exchange loss that they had considering the Nigerian FX markets. So my objective is not to analyze. As I said, I only want to review the valuation and focus on key things. So net profit margin, negative. Then I also took a look at what their net working capital has been to their revenue. Then 2023, you can see that's a significant increase, which is also understandable, right? Which is understandable considering they have to manage their cash here and there. So if you go straight to the balance sheet, you can see the net working capital, how it's increased, right? inventory almost double what they had in previous year. Trade receivable increase, that one is still even slightly significant. Then prepayments, they had to do few prepayments, considering the FX unpredicted. You can't predict the FX, and so you just try to see how you can manage things. They had to hold on to few cash, right? Considering what's going on, so you can see how that has driven their net working capital as to revenue. Then their capex, look at their historical capex to revenue. All right, and this is what the margin kind of look like. So we've set up almost all the line item as a driver to revenue. Yeah, I know people might have another opinion, especially on this depreciation and amortization, where they say no, don't use it as a percent to revenue. Yeah, you might be right. As I said, just keeping things simple, and you just don't want to stress yourself trying to do some things. So just keep it simple. That's just my own concept. So revenue is like the umbrella of the business, and its impact and drive everything. Even though yes, depreciation really might not have much to do with revenue, but if capex the factor of revenue, then let's consider depreciation as the same. But if you have different opinion, yes, you might be right, as I said, and that's one thing I love about finance. It's not a one-way thing, right? Diverse creativity, but the question is, does it make sense? So now let's go straight to the DCF and let's review this together. So those key line items that I need to calculate my free cash flow, revenue, look at the historical growth. Then what I've done is for the first year, I've adopted the last 3 years average, considering they have a consistent trend. And now, considering this is a mature firm, yes, I would have kept this 22.4% constant. But I feel, you know what, this is a mature company. We are not saying the revenue will not grow, but it might tends to be more like a downfall a growth kind of thing. So what I've done is I've reduced it by 0.5%. Yeah, right. So you can see here this period 0.5%. I wanted to even reduce it by 1%, but I might be don't let me be too aggressive considering what they've achieved in the last 3 months. Also, continuous inflation increments in Nigeria seems, because that definitely drive increase in pricing in different costs, which they might definitely need to adjust, right? So I just reduce it by, okay, you know what, don't let me be too the ash on them. So I reduced that by 0.55%, right? Then operating expenses. So the average of the last 3 years, I also adopted that. Then I also increased it by 1% for the forecast. And the reason is because I'm saying, yes, the inflation will definitely have impact on them as we experience in FY23. However, yes, we expect the management to be able to control it, but get to a point there, the, it's just beyond your control. All right. So what I did, added 1% for FY25, right? The other period, then the other one, I just try to, okay, but at least before they get to the next 4 years, they should be able to, everything should stabilize, right? So yeah, this forecast growth is still within the historical margin. So I feel kind of comfortable with that. As I said, it's not a one way. Might be wrong. You might feel different. So that's allowed, and that's the beauty of finance, right? So depreciation to revenue, I also adopted the average for the past 3 years. Now for the net working capital, in adopting the average, that would give us around something like 2.2%. But that might alter my changes in net working capital. So you know what I did? I adopted the one they had in the previous year, right? And I hope the business will be able to will be back to their normal net working capital to revenue margin. So what I have to do is just to reduce it by 0.5%, right? Considering what we've seen in FY 23. If yes, you can adopt the average. I'm not saying you are wrong, but as I said, I think I feel comfortable, right? Considering that we also want to try, because 2023, I'm sure most of us we've reviewed their business performance in FY22. I'm sure no one would have predicted their net working capital to revenue to just increase significantly like that. So I feel 2024, they are still we are still facing the same economy. So I'm keeping that constant. Then I've decreased that by 0.5%, or if I want, I can even decrease it by 1%. But I think this should be hopefully during the next 5 years, they should be back to um, their normal historical trend. So capex to revenue also adopted the last three uh, period, and I just kept that constant. For the tax, I look at what the effective tax rates, what they've had over the forecast period, and luckily the average seems to even match the current corporate tax rate, even though it has been increased to 33% or 32.5. But you know what? I'm using the effective tax rates and not the applicable tax rate. So I also extracted the Nigerian forecast inflation for year FY 2028, right from, I got that from EIU. Now, went ahead to build my free cash flow. So I forecasted my revenue for the next 5 years, from three, 4, 5, 6. You're right. Do I think they can achieve this? As I said, it depends, right? But considering the increment, the inflation and economy of the Nigeria, right, which will drive costs, which might later impact pricing and the whole thing, as we've seen what happened in 2023, that they had to also increase their tariff, their charges, and things like that. So yeah, that might drive the revenue like that. But you know what? I've also considered that same thing in driving the cost. So we have the EBITDA margin. I've calculated my depreciation, right? Make provision for the tax, then add depreciation and amortization, changes in net working capital, then with less capital expenditure. Now, of relating to this tax, I know they have. So if you go into their balance sheet, right? Balance sheet as per audit. So I'm sure they have deferred tax. Okay, yeah. So they have deferred tax assets, right? And so they also have deferred tax liabilities. Now, based on the based on the concept of using income approach, all the line item needs to find a way to eat your free cash flow, right? But I'm going to keep it simple this time. Normally, what we would have done is we would have made provision for that deferred tax asset and liability, do the adjustments, which will then impact this tax. So maybe in subsequent one I will be reviewing, I will show us how we make that adjustment. But for this, you know what? I've decided not to consider the deferred tax assets and liability, right? Because they have both in the balance sheet assets and as a liability. Yes, as I said, normally I should have considered that. But I think wait, let's check. I think I considered that in the net working capital, in the net debts. Let me see. Let's see. Okay, yes. So deferred tax is here. Deferred tax liability is here. Yeah, right. So that's one way, right? But the most appropriate way we use is we need to review the tax schedule, the net of each, and for us to get how much they will need to pay, because tax relief and all those things. Consider they also made loss and things like that. But for this one, let's keep it simple and let's see what we get. Now, after that, I've also computed the terminal value, right? And using my Nigerian of long-term inflation rates that I've gotten from EIU, and that's at 11.4%. Yeah, some people might feel that is way too high, right? I agree with you. You say that, but you know what? Yes, I'm going to use this. Then what will now account for the adjustment would now be my WAC, my cost of my discount rate, which I'm still going to show you. So here we've computed the terminal growth to see what that might be, and in that we've used that to get our terminal free cash flow, which is the what, which is the free cash flow at a terminal period, right, divided by my discount rate minus my growth rate. So then I have this. So I've also computed I've decided to use a mid period adjustment for my period, right? Yeah. So basically, we are saying this cash, yeah, even though their period is January to December, right? Most of them might, because of cash receivables, adjustment, accrual basis, and all those things. So it might split within the period. So we've decided to make adjustments and use a mid period and increase that subsequently. Discount, we've gotten our what our discount rate. So now let me walk through. Let's go straight to the WAC WAC computation. We've adopted the risk-free for Nigerian rate, Nigerian 10-year bond yield. So that's what we've used. And remember, this is as at December 2023. So which means if we are reevaluating this business today, the valuation might be different, right? Because definitely the changes in this macro data as well. Then we went ahead to extract the unleveraged beta. We got that from Damodaran, right? So if I take you there, we've adopted the telecommunication industry, telecommunication service, right? We've adopted their unlevered beta, right, in getting it. Then debt to equity, we have a marginal tax rate, which we've considered 33%. Then obtain the equity premium, right, also from Damodaran data. This is equity premium for Nigeria. And as I said, remember, this is as at 1st December, that 1st December 2023. So small stock premium. Now, for the small stock premium, yeah, I know this is a public company, right? And I know most people would have said, you know what, we should not consider it, which means it's supposed to be zero because this is not a small business. They are publicly listed. Their stock is everywhere. But I don't know. I just feel, you know what, just to be conservative and yeah, I know it's a large entity, but you know what? I'm still going to go with that 0.5%. Yeah, I might be wrong, I might be correct, but I just want to see how that would play out on their share price. And most times we also create different scenario around that. Now, firm specific risk premium, considering the forecast cash, is it achievable? Is it reasonable? So many factors, right? I wanted to even consider 2% here. And this is just so this is based on a typical. This is based on our typical valuation, judgmental, and perception. But you know what? I think 1% is fair enough. I feel they can achieve those cash flow that has been forecasted. Small stock premium, yeah, some people might be like, you know what? No, you should not consider that. Yes, I agree with you. But you know what? I feel let me just give you 0.5%, right? Considering just so many different factors. So here, cost of debt, we've adopted the synthetic risk premium, spread above risk. Here I've examined some investments from platform like FMDQ, right? And I've taken a look at their spread. Some are even around 1.5, 1.6, but I've decided to adopt a 2.0. As I said, yes, I might be wrong, I might be correct, but my view. All right. So the capital structure, I've also adopted the debt to equity applicable to the industry from Damodaran data, and here we've calculated our debt to invested capital and equity to invested capital. And that gave me a WACC of 21.4, 21.1. You're right. Yeah, some people might feel this is too aggressive, but you know what? I don't know. I just feel comfortable with this. So I was valuing this as at December 31st, and at today, I'm sure our NPR has even gone up to almost 22.5. So, which means I feel I'm good with this, right? As I said, its valuation is an art, is an act, is an art. If you have different perspective, you have different perception. Any one you decide, right? You are the one drawing it, and as you've decided to draw it. So now let's go straight to our valuation. Let's go straight to our valuation. So here I'm having an enterprise of 6 billion. So remember, everything here is in million. So you should remember that. So 6 and calculation for my net debt, and I have my equity value. All right. The outstanding shares, and I'm getting a share price of 234 on naira. All right. Not 34 naira. So maybe I can even include this here so that we know that this is in million. Right. So yes, even though we've stated it up, it's always good. So this is just in million. Right. Why this one is in naira. Okay. So now, I also went and checked online to see what was their share price as at December 31st, and I think it was around 264 of a thing, right? So I also computed our sensitivity table, and I'm getting a range of 6.5 to 7.1, right? And I went ahead to also do a market approach so that I can corroborate with what I've done, right? I got this from Cap IQ. So the last 12 months EBITDA, the low and the high, and the next 12 months EBITDA, the low and the high, all right? And I also selected their last 12 months EBITDA value from the financials and from the forecast. And I'm also getting, for the last 12 months, I'm also getting a 6.5 and 7.2, which is also within the range of what I've forecasted. Next 12 months is saying within the range of 7.1 to 7.7, which I still feel is still fair. All right, so I can create a football charts, right, that just tends to show everything. And so now, some say yes, 234. Am I being fair enough? I think so, right? But as I said, please, this is only for learning purposes. And if you want to see that stock, that small stock premium, if you decide to make that zero, let's see what the valuation will kind of look like, right? So this jump to 7, equity value jump to 5. So you can see how impactful. So let me update my data table. So you can see how significantly those our work data can affect the valuation, right? Yes, even though with that we still fall within the range of the next 12-month EBITDA within 7.1 to 7.7, right? But as I said, yes, the cash jump, the revenue jump is I feel is huge, right? Three, then 4 to 5 to 6. Yes, even if you take a look, if you take a look at the historical, you can see for almost 3 years they've been on almost one, right? Then last year they moved to two. So I feel even for the next uh, but yeah, because of the significant increment in the inflation factor, yeah, this might drive their revenue to increase significantly. All right, so yeah, I feel comfortable with that, but you know what? I feel having a work of 21. So let me put that to something 0.5. So this 0.5. So for some of these, we have sources where we get them. For small stock premium, we have this table, right, from 1 to 10 decile and something like that. So you might need to do your own research on how to get that. So yeah, I also decided to make some free information hidden, right? So firms specific risk premium, yes, there's a way we also get it. So I'm sorry if I'm not telling you everything. So spread above risk, yes, there's also a way we get it as well. So in fact, for this capital structure, at times we take our time to even get comparable data, then we do these different adjustments here and there. But I'm keeping it simple. And also for the multiple, yeah, we also do where we create a full comparable multiple, right? Then we do the adjustment, risk adjustment, country risk adjustment, firm size adjustment, and all those things. But we tried to keep this simple. And as I said, please, this is only for learning purposes only, all right? And no one should make decision based on this, right? Okay. So not sure why my data table is not updating. Let me check again. The data table is not updating, so let me do it again so that I can give us what we want. So just my formula that I'm changed to. Okay, so I think this should work now. Okay, all right. So because of our work, so let me copy this work, right? And so that's something about this data table. Um, you always need to always update your data anytime you do the adjustment. So yes, enterprise value 6.5 to 7.1. I feel comfortable with that, and as I've corroborated that with the last 12 months. Right. So yes, thank you. And this is where we'll stop for this session on MTN and Nigeria. So please, in case you want us to also, so we plan to be doing this, maybe release the video, do few review of few entities. If you also want to contribute, you can reach out to me. Just drop a chat, and I will reach out to you. So, and also if you want us to also review any other entity, please, only for learning purposes. Please remember that, only for learning purposes. I might be wrong, I might be right, all right, but this is just me doing a knowledge sharing for most of our guys that are just entering the industry, and they understand how you go about this when you are doing it. So if you have any other companies you want us to also review or take a look at, please just drop that in the chat, in the comments, and trust me, we'll take our time to also look through it. So yes, thank you once again. My name is Victor Okundeli.